This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. Purchase loans remained flat last week as sky-high prices and rising interest rates make home buying too expensive for some customers. And now even Congress is looking for solutions, with a House Financial Services subcommittee holding the first of two hearings Tuesday. Committee members wanted to understand whether investors are artificially driving up prices by buying more and more properties. So will Congress do anything to help bring down prices? Can they even agree on the root of the problem? Our own Christine Stewart has more.
Lawmakers on the House Financial Services Subcommittee on Oversight and Investigations were divided on the impact of institutional and private equity investors.
This hearing is misdirected. Our committee must wake up and focus on solutions to the problems Americans have today, because no American should have to cut back on essential expenses like groceries or gas to make ends meet.
But Democrats disagreed.
We know that there's a supply chain problem that has been going on ever since this pandemic started. The institutional investors, as it has been called, who simply go into these communities and they buy up large numbers of homes.
Witnesses testified that these investors are outbidding low and middle income Americans for houses, then renting them out and evicting tenants at alarming rates.
In the first quarter of 2022, investors made up a record 28% of single-family home purchases, up from 19% in 2021 and 16% on average between 2017 and 2019.
Jim Baker with the Private Equity Stakeholder Project says investors with large portfolios drove most of that growth.
Large single-family rental landlords like Pretium Partners, Invitation Homes, and Amherst Holdings were among the most frequent eviction filers we saw out of all landlords, including when the CDC eviction moratorium was in effect.
He says they also found these investors were filing eviction notices in black counties in Georgia at higher rates than in white counties in Florida.
More alarming, the investors are targeting minority communities since historically they're undervalued, lower priced, and driving up the prices for residents, making the Houston dream of home ownership for the population unachievable.
Shad Bogny, past chairman of the Texas Association of Realtors, says it's exasperating the generational wealth gap in these communities.
Home buyers are having to compete with investors that are paying cash over the list price, resulting in an increase in investor purchases.
Many researchers have found that institutional investors crowd out homeownership at the neighborhood level. We see this in Atlanta, where homeownership has fallen by 6% since the mid-2000s.
Alora Lee Raymond, a researcher at the Georgia Institute of Technology, says they can attribute 1.4% of the decline in home ownership to institutional investors.
Particularly during the pandemic, institutional investors have outbid homeowners and mom-and-pop landlords trying to buy single-family homes.
But not everyone sees institutional investors as the problem.
The growth of institutional investors is a symptom rather than the cause of extremely tight housing markets.
Jenny Schutz, a senior fellow at Brookings Metro, says rental housing is attractive to investors.
Private equity firms and other institutional investors benefit from tight housing supply, but they did not create the problem. Local governments across the U.S. have adopted policies that make it difficult to build more homes where people want to live.
At the same time, Schutz says rising housing costs create the greatest hardship for low and moderate income households. The poorest households in the U.S. spend more than half of their income on rent. So what's the solution?
There are no silver bullets to make housing cheaper and more abundant overnight. Helping renters and home buyers will require sustained and coordinated policy efforts from federal, state, and local governments.
Today, the subcommittee will hold another hearing on inequality, home ownership, and the long-term impacts of the hot housing market. For the Mortgage News Network, I'm Christine Stewart.
As we mentioned at the top of the show, purchase loans remained flat last week, but overall origination was up 0.7 of a point, driven by a 2% bump in refis. The MBA says that this is likely because of fluctuations in rates. After jumping up 65 basis points, the rate for the 30-year fix slid back down to 5.84% last week. The decline in mortgage rates led to a slight increase in refinancing, driven by an uptick in conventional loans. However, refinances are still 80% lower than a year ago and more than 60% below the historical average. Allegations of poaching are growing, with new companies getting involved. And in these cases, companies are targeting the employees who allegedly tried to divert clients or take company data. Earlier this month, Pacific Valley Bank filed a lawsuit against former senior vice president and senior business banker Joseph Servi, who left for Pinnacle Bank. Pacific Valley Bank says that Servi was able to get confidential information as the lead development officer. He also allegedly sent an email to clients informing them of his move. In the email, he described Pinnacle as a community bank with a larger lending options that will help my customers, an SBA department, a robust online banking platform and cash management tools, and last but not least, very competitive rates. Meanwhile, Shamrock Home Loans is suing former business development recruiter Caitlin Handler. Shamrock claims Handler emailed company secrets to her personal account, including documents called the Master Pipeline Spreadsheet, Shamrock Scripts, Battle Card Competing Companies, Prospect Contact Information List, and the Shamrock Competitor Analysis Framework. And finally, First Guarantee Mortgage Corporation is defending its handling of layoffs of more than 400 people. Yesterday, we reported that FGMC laid off roughly 3/4 of its staff via a virtual meeting, and employees we talked with say that they were not offered severance at that meeting. Well, a company spokesman responded by saying, "We want to clarify that we have paid salaries, accrued PTO, and commissions that have come due, and are in the process of making severance payments to those who are eligible." FGMC also says that it will fund loans and actively engage with consumers.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.